We all dream of having a safe and sound financial future where our money grows all by itself. But sometimes getting rich seems really hard and confusing. The truth is, building wealth doesn't have to be so complicated. It's all about making smart choices regularly. One smart choice is investing in a systematic investment plan, or SIP. Think of an SIP like a plan to grow your money steadily. It's like planting a seed and watering it often. With patience and by doing it regularly, you can watch your money grow. Simply put, an SIP is like an automatic savings plan for mutual funds. It stands for Systematic Investment Plan, and it allows you to invest a fixed amount of money at regular intervals, typically monthly. This method is designed to help you build wealth over time without the stress of trying to time the market perfectly. Instead of putting in a lot of money at once, you invest a little bit regularly, usually every month. This approach is beneficial because it encourages disciplined saving and investing. By committing to invest a small amount regularly, you can avoid the temptation to spend that money elsewhere. This steady way of investing makes it easy to get into the stock market and try to grow your wealth over time. It also helps to mitigate the risk of market volatility. When you invest a fixed amount regularly, you buy more units when prices are low and fewer units when prices are high, which can average out the cost of your investments over time. Now you might be wondering, how is an SIP different from investing a big chunk of money all at once? The main difference lies in the timing and the psychological impact. Investing a large sum at once can be daunting and stressful, especially if the market is volatile. With an SIP, you spread out your investments, which can make the process less intimidating and more manageable. Well, imagine you have some money to invest. You could put it all in at once, which is known as a lump sum investment. This approach can be effective if you invest at the right time, but it also carries the risk of investing at a market peak, which could lead to significant losses if the market declines shortly after. You could put it all in at once. However, this requires a good understanding of market conditions and a high tolerance for risk. Not everyone is comfortable with this approach, and it can be challenging to predict the best time to invest a large sum. But with an SIP, you spread your investments out over time. This method reduces the impact of market fluctuations and allows you to take advantage of different market conditions. By investing regularly, you can benefit from the power of compounding, where your returns generate their own returns over time. This difference can really change how your investments do. An SIP can provide a more stable and predictable path to wealth accumulation, making it an attractive option for many investors. By staying committed to your investment plan and regularly contributing to your SIP, you can work towards achieving your financial goals with greater confidence and peace of mind. Starting to invest with an SIP is easier than you think. First, pick a mutual fund that matches what you want to do with your money. Think of mutual funds like baskets of stocks or bonds managed by experts. After you pick a fund, you can set up an SIP with the company that runs the fund or through a safe website. You pick how much money you want to invest and how often. The great thing about SIPs is that they're flexible. You can start with a little money and add more as you earn more. Section 4. The great thing about SIPs, unlocking financial growth. In this section, we will delve into the numerous advantages of systematic investment plans, commonly known as SIPs, and how they can be a game changer for your financial growth. SIP investing has some really good advantages. First, it's super affordable. You don't need a large sum of money to start investing. This makes it accessible to everyone, whether you're a student, a young professional, or someone looking to diversify their investment portfolio. You can start investing with just a little money, which is great for new investors or people who don't have a lot to invest. Even small, regular investments can grow significantly over time. This is particularly beneficial for those who are new to the world of investing and may feel intimidated by the idea of needing a large initial capital. Second, SIPs let you use the power of compounding. Compounding is a powerful financial concept where the returns on your investments start generating their own returns. This means that the money you earn from your investments begins to earn money itself, creating a snowball effect that can significantly increase your wealth over time. Compounding is like earning money on the money you've already earned. The longer you stay invested, the more pronounced the effects of compounding become. This is why starting early and staying consistent with your investments is crucial. Over time, this can really boost how much money you make. Imagine your investments growing exponentially, providing you with a substantial financial cushion for the future. This can be particularly useful for long-term goals such as retirement, buying a home, or funding your children's education. Finally, SIPs use something called rupee cost averaging. This is a strategy where you invest a fixed amount of money at regular intervals, regardless of the market conditions. This approach helps in mitigating the risks associated with market volatility. Because you invest regularly, you buy more when prices are low and less when prices are high. This strategy ensures that you are not overly affected by market fluctuations and helps in averaging out the cost of your investments over time. This balances things out and makes your investments less affected by market ups and downs. By spreading your investments over time, you reduce the impact of short-term market movements and focus on long-term growth. This makes SIPs a reliable and effective way to build wealth steadily and securely. Section 5. SIP versus lump sum. Comparing your investment choices. Both SIPs and putting in a lot of money at once have good and bad points. SIPs are great for people who like to invest regularly, want to lower risk by buying at different prices, and are okay with waiting for their money to grow over a long time. Investing a lot of money at once might be better for people who have a lot of money to invest right away and want to try to make more money faster, but it can also be riskier because the market can go up and down. Section 6. Ready to start your SIP journey? Here's how. Starting your SIP is as easy as picking a good mutual fund company or website. Begin by researching various mutual fund companies and their offerings. Look for companies with a strong track record and positive reviews from other investors. Look for websites that are easy to use, have lots of fund choices, and good research tools. These tools can help you compare different funds, understand their performance history, and make informed decisions. Once you've picked a website, make an account, do the KYC, know your customer process, and pick your mutual fund. The KYC process is essential as it verifies your identity and ensures the security of your investments. Decide how much you want to invest and set up automatic payments so you don't have to think about it. Automatic payments ensure that you stay consistent with your investments, which is key to building wealth over time. Remember, SIPs are good for all sorts of investors, from young people just starting their careers to experienced investors who want to grow their wealth over the long term. SIPs offer flexibility, allowing you to start with small amounts and gradually increase your investment as your income grows. They also help in averaging out the cost of investment, reducing the impact of market volatility. So, whether you're saving for a short-term goal or planning for retirement, SIPs can be a valuable tool in your financial strategy. Section 7. Use the power of SIP for a brighter financial future. To wrap up, SIP investing is a great way to reach your money goals. It's simple, affordable, and good for the long term, making it a good choice for new and experienced investors. By starting early, keeping your money invested, and using the power of compounding, you can build a safe and successful financial future. Like with any investment, it's always a good idea to talk to a financial expert to figure out the best plan for you based on your situation and how much risk you're comfortable with.